This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our first session together here on Chapter 4, what we've seen as the main part of this particular chapter relevant to your exams is that we have to adjust up the accounting profit to make it acceptable for taxation purposes. The starting point for this exercise on your so-called adjustment of profit statement is the net profit at the bottom of your financial accounting statement of profit or loss. So we pick up the net profit. We don't try to produce an entirely new taxation statement of profit or loss. Start with the bottom line accounting net profit and then adjust. What adjustments are required? Principally, and the main part of any answer, is going through a lengthy list of expense items and determining whether any of those should be disallowed. There may be perfectly valid accounting debits, but they're not allowable for taxation. Our favourite amongst those, depreciation, replaced, of course, as we'll see in Chapter 5 in our next session together, with capital allowances there. But we go through the expense items looking for those that are not allowable for tax, and we add back. With depreciation, it's the full amount. With many other expense items, we'll get an analysis. So you'll see a figure given as the debit on the statement of profit or loss, and it's referenced to a note. We analyse that note to see which particular bit, for example, in terms of entertaining and gifts there, which particular entertaining or gifts expenditure should be disallowed. What we do, and what we are required to do in terms of your exam answers anyway, is also, as per the requirement of the question, as it will state, if there's something listed in the question, but it requires no adjustment, then you have to record that on your adjustment of profit statement, but with a zero adjustment. So you can't just ignore items when you don't know what to do. You've got to deal with every item listed, saying, is it allowable, in which case zero adjustment. If it's an expense item that is disallowed, we add it back. And of course, if there is a credit side of the statement of profit or loss, if there's anything non-trading, like property income, interest income, dividend income, or whatever, more likely a profit on the sale of an asset, if there's anything of that nature that is not trading, then that is to be deducted in the adjustment of profits. Now we've worked through as far as this one here, identified as K, fines and penalties. Now clearly if the business breaks the law, then you are not going to have any fine that is charged, any penalty that is charged as an allowable expense. So the basic rule of thumb here is that we'll disallow any fines and penalties. But there is one concession here from HMRC. And although we said they will be disallowed unless, and the concession is for a parking fine paid on behalf of an employee and incurred whilst on business. So a little concession here to say, look, okay, if your salesperson has put their car on a double yellow line while he's rushed in for a late business meeting, come out and found he's got a parking ticket, and you, the company, the employer, has paid the parking fine. If they've done that, then by concession it will be allowable. But basically any others, typical ones you see would be the business has had a fine under the health and safety rules and regulations. Clearly you've broken the law, the business has broken the law, and therefore it's not allowable. Next one. The accounting profit must be adjusted for private expenditure of the business owner, the proprietor here. Any private use by the proprietor of any expense item is disallowed. We're only going to allow business expenses. So where might we see this? Well, pretty typical one is on motor expenses, because what we discover is that the figure debited on the statement of profit or loss for motor expenses is actually all of the motor expenses of the vehicle used by the owner of the business, the proprietor. But then we're told that actually not all of the mileage is indeed business. Well, you wouldn't expect it to be. Some of it is private. Therefore, the private element we must add back. So, for example, here, if the owner uses a car in the business and 20% of his mileage is private, then only 80% of motor expenses are allowable. So what do? We add back the disallowable bit, the 20% in the adjustment of profit. Now do be careful here to read the question carefully, because what they do is sometimes, and maybe on one item, you may have more than one to deal with, they tell you, oh, this was the private use percentage, and on another one they tell you this was the business use percentage. Just read it carefully as to which it is. Remember, what we're disallowing, what we're adding back, is the private use. Sadly, some students, and it's especially tragic on, say, an objective testing question, they go and get it wrong by actually adding back the allowable bit, the business use element. That's what's allowable. It is the private use that is disallowed, and it is it that is going to be added back. Make sure you read the question carefully. If the owner, however, provides an employee with a car, like a salesperson there, and 20% of that mileage was for private use by the employee, then the full amount of motor expense is allowable. No add back, no disallowance. The reason being that the employee is going to be taxed on the private use as employment income. That if an employer provides an employee with a car, then the employment income assessment for the employee, that will include the assessment in relation to the car benefit. So that will be sorted out within the income tax system as an employment income. Something we'll see, as I think I said to you last time, in Chapter 9 there, where car benefits are, again, eminently examinable. So we'll deal with that then. But so far as we're concerned now, watch out for that. Don't just see private use and think add back. Who has the private use? Private use by the owner, the proprietor, add back. Private use by an employee of the business, that is allowable. Next one, any deduction described as owner's salary or drawings or interest on capital invested in the business is disallowed. Again, if the proprietor takes money out of the business, those are drawings. Drawings, as you know from accounting, are not an expense. Now, they might try to rename it the owner's salary. No, he doesn't have a salary. This is an unincorporated trade. What the unincorporated trader has is an adjusted trading profit. They do not have a salary. So, if you get that management salary, management fee there, those are drawings, and hence they are added back, they are disallowed. Next one, interest paid on overdue tax is not deductible. Yeah, if you were late paying your tax and you then have to pay interest for the period for which it was overdue, don't expect to get tax relief there. Interest paid on overdue tax is not deductible, and interest received on overpaid tax is not taxable. Both of those outside the scope of the taxation system. Another one to watch for, and we're in an area here that in terms of adjustment of profits, we're looking at basically the income tax, here the unincorporated trader. I mentioned to you earlier, most of the rules on adjustment of profits are the same, whether you're dealing with an unincorporated trader, here in income tax, or an incorporated trader, later in corporation tax. But whereas we've got a lot of private use by proprietors to deal with, and maybe money taken out or goods taken out of the business by the proprietor, we don't see that in corporate tax. There's no private use issues there, as there is here in income tax. But another side of that is if you employ a close relative, member of the family, any salary paid to the family of the owner of the business must not be above the normal commercial rate for the job. Only the salary at the commercial rate for the work done is allowable there. Yeah, what you can't do is to employ your spouse within your trade and then overpay. So why might you do this? What you might have in an exam question, and dealing with the exam question is very easy, you're told taxpayer statement of profit or loss, self-employed, unincorporated trader, employs spouse, pays the spouse a salary of £20,000. Then you're told, because they've got to tell you this, makes it really easy, that a normal commercial rate for that job would be £17,000. Therefore, the £3,000 excess, the amount above the normal commercial rate, is disallowed, and you add that back. Now, of course, you might have paid £20,000 and the normal commercial rate was £10,000. Be £10,000, therefore, to add back as being the difference. Not that as such at this stage you need to know, because this is just the adjustment of profits. But in terms of tax planning, why is it that an unincorporated trader might wish to pay more to his or her spouse than would be the normal commercial rate? Well, that you should be able to answer if you think back to the fact that in income tax, in Chapter 2, each spouse had their own income tax computation and their own income would be attracted to it. If therefore the unincorporated trader has £60,000 worth of income, they are a higher rate taxpayer. So on a significant part of that income, they're being taxed at 40%. If their spouse has only got £10,000 of income, then they're not even using all of their personal allowance. So if we could move some of the £60,000 of income to give to the transferee spouse who's got £10,000, then any amount of personal allowance that we could then use up, that would save tax at 40%, because instead of 40% it's 0, and then into basic rate tax, taking it from the higher rate taxpayer, where it would have been taxed at 40%, and attributing it to the basic rate taxpayer, where it will be taxed there at 20%. Now, that was something we were familiar with in terms of income producing assets and transferring ownership of those income producing assets there from one to the other to save tax, to move it from basic or higher into the level of tax-free income to use up a personal allowance. Move from higher to basic rate, as I've just mentioned there. Perfectly fine. What you can't do is to pretend here that someone is actually or should be having a higher salary than what would a normal commercial rate be. So all you've got to do in adjustment of profits, you'll be given the two numbers. If you're paying above the normal commercial rate, you've got a problem with the HMRC, you've got to add that back. If, of course, you're paying your spouse at below the normal commercial rate, you haven't got any problem with the HMRC, you've got a huge problem with your spouse there. Okay, coming back to the next page here on your notes, again, it's a similar area, something to do with the proprietor. And this is one to watch for, another regular one in terms of examination questions. And that's where the owner takes goods from the business out of stock for his or her own use. The rule: if you've taken goods for own consumption as a proprietor, then we must add back the item as a sale at market value. So the basic rule is you help yourself to a stock item, think what would have happened in the accounts. When it was bought, you debited purchases, it's a part of the cost of sales. However, it's never sold and it doesn't feature in closing stock because you helped yourself to that item. Now that therefore is not going to be tolerated. So what is the rule is we add back at selling price. Now there we have another problem. That what happens in accounting is that seldom do you just help yourself and not record it. What would happen is, having recorded the purchase and debited the cost to purchases as part of cost of sales, when then you take those goods for your own consumption, you would credit purchases and debit drawings. So you'd cancel it out. Now that may be fine for accounting. Not good enough, I'm afraid, for tax. So a typical one that you may see would be something like this, that the individual took goods from stock that were in stock at a cost of £600. Their resale value, their market value, was £1,000. And what we're then told is whether or not already within the accounts any adjustment has been made. Adjustment, that is, for the cost of the goods taken. So if all that was happened is you took the goods, no adjustment through the accounts, add back at selling price, you'd add back in your adjustment profits £1,000. Or if the question says, took the goods, cost 600, they're worth £1,000, but the accounts have been adjusted for the cost of the goods taken from stock, i.e. you've done the accounting entry to reverse that purchase cost. Fine for the accounts, not good enough for tax. We've now got to add the profit element. So the cost was 600, the sales value was £1,000, therefore add back £400. So read the question, as we keep saying, very carefully. Have we just taken the goods from stock and done nothing in the accounts, add back at selling price? Or have we taken the goods from stock and adjusted already for their cost in the accounts, in which case add back the profit element there? Nearly there. If you're dealing with a new business that has just commenced to trade, what you might have is what we call pre-trading expenditure. And it's fairly common that you might have a situation where a business started trading on the 1st of January 2017, shall we say. But of course, before it could start trading, maybe the individual opened a shop, and therefore we had to acquire shop premises, we had to fit out that shop, buy in our stock, before then we could start to sell it. Well, the expenses to do with the property there. If you were renting the property out, so maybe you entered into a rental agreement at the beginning of November of 2016, and you went in, you redecorated, you put in all the various shelves and display units, then all of that expenditure of a revenue nature that you incurred would be pre-trading expenditure and would be allowable. The fact that it was incurred prior to the start of the trade is not a problem. Again, up to 7 years, in fact, you can go back. It's never going to be that far in terms of exam question. It's usually just in the weeks, maybe months running up to the start of trading. Now, the only thing to watch out for here is we'll allow pre-trading revenue expenditure so long as it would otherwise have been allowable had it been incurred post the commencement of trading. So, for example, if you were entertaining potential customers in this run up to starting the trade, and if we look back, let's get the pen to work. If we look back up here, we will see that entertaining is disallowed there unless you're entertaining employees. So there you have an expense that even if you had incurred it post commencement of trading would not have been allowable. Well, clearly, therefore, whether you commenced it pre or post, it's disallowed. You will not get relief for it. But if it's pre-trading, revenue expenditure of a nature that would have been allowable had you incurred it post commencement of trading, it's no problem. It is allowable, no add back. The overall general rule that we have here as regards the allowability of expenses is they have to satisfy two basic criteria. That is that they have to be incurred wholly and exclusively for the purpose of the trade. If it fails that general test, then it's not allowable. It has to be incurred wholly and exclusively for the purpose of the trade. Okay, now you'll need time and practice here to get to grips with these items, but it is the case that in every examination, whether as a written question in section C or as an objective testing question, some work, some marks, don't know how many, but some marks will be available in relation to adjustment of profits. The only other thing I cannot tell you for certain is whether the adjustment of profit exercise that you're called upon to deal with will be as we're dealing with now, here in Chapter 4, for the unincorporated trader, so it's income tax, or whether, as we'll see later in Chapter 16, if it is corporate tax and we're dealing with incorporated traders. The rules are mostly the same. There are some differences, principally, as I said, there's no private use in corporate tax. So when you deal with this in an exam question, always look very carefully. For example, it might be an objective testing question. First thing to look at is not just the expense item, but who's the trader? Is the trader a company or is the trader an unincorporated trader? Before you start to deal with those adjustment of profits issues. Be warned. Okay, well, we've got our example here, example 1, to now work through and what is the requirement on this, as it always would be, to compute for the taxpayer, here the taxpayer is Jeremy, tax adjusted trading profit for the year ended 31st of May 2017. Now, if it's a written question, then we'll set up our adjustment of profit statement for Jeremy, and it's for the year ended 31st of May 2017. Here, as they say, is one I prepared earlier, and it would look like that. So, who are you preparing this document for? It's for Jeremy. What is it? It's an adjustment of profit statement. When is it for? Accounting year ended 31st of May 17. The starting point for the adjustment of profit process is the net profit as per the accounts. That figure, 30,200, which we have taken, let's go back to here, which we have taken, of course, as that net profit there at the bottom of our statement of profit or loss. Now, that would be how we respond to a Section C written question, but any of the individual items we're about to see could be a part of an objective testing question and tested independently. Either way, we need to learn these rules. Okay, so we've started with the net profit. If we have got the full-blown adjustment of profit exercise to do here, what I would now suggest that you would do. Again, it's no good just reading through the information in the question. I've got time to read it and think, well, that was interesting. What do I do now? We read the requirements, understand what is required of us, and we start to answer the question as we go through. And that's the bit that I'm going to take you through. You can do the administrative exercise, the secretarial function of writing it up on that adjustment of profit statement for yourself. But let's see how we earn these marks and, of course, within the available time. First thing we do, having picked up the accounting net profit, go to the top of the statement of profit or loss and come down that, looking for any items there where you don't need to refer to a note. There will be several of them, as you can see. The mere fact that it is there is enough to say that shouldn't be there, and therefore it needs to be adjusted for. Now, we don't have to look too far for that, because here in the list of expenses, the first one is depreciation. That one, not allowable. So on your question page next to it, we can write plus. That will be added back. If we got loss on the sale of a fixed asset, again, it's depreciation by any other name added back. All the items here are expense items debited. There could be credit items. If we put a profit on the sale of a fixed asset, well, that is not trading income. Again, profits and losses on disposals of assets are just arising out of under or overcharging of depreciation, and depreciation is not an allowable expense. So loss on disposal, add it back. Profit on disposal, subtract. Take it out, deduct. Adjustment of profit is a simple concept. You can adjust in either of two ways. You can add it back, plus, or you can take it away, minus. It's one or the other. And in between there, what there will be is zero. If there is no adjustment, it's a perfectly allowable item. Zero adjustment would be required. Okay, here therefore the depreciation. If we've got profit on sale of the asset next to it without reference to a note, we would put a minus sign. If there was property income, if there was interest income, if there was dividend income credited on that statement of profit or loss, they ain't trading income. They may or may not be taxable, but they're taxable in their own right, not as a part of trading income. So here we would take them out. Now, when we look at the remaining expense items, what we can see, of course, there is each of them has a note referred to them. and hence therefore we must now look at those notes. So light and heat, note 1 there, and also rent and rates is note 1. What does note 1 say? It's to do with the accommodation, private accommodation. Jeremy and his wife live in a flat that is situated above the clothing shop. Of the expenditure included in the statement of profit or loss for light and heat, rent and rates, 40% relates to the flat. There you go, you've got 40% private use in relation to heat and light. So back to that item on your statement of profit or loss, plus 40%. We're going to have to add back the private use expenditure. Also applicable on rent and rates, plus 40%. Now, we're told there 40% relates to the flat. The flat is the private bit, that's the disallowed bit. If they told us that 60% was for the shop, again, same adjustment, add back 40%, because 40% would be the private use. Check out which figure they're giving you. Is it the private use? That's the bit you disallow, you add back. Or if they give you the business use, that's the allowable part. If the allowable part was 60%, the disallowable private element is 40%. That's the bit you add back. On to note 2 for motor expenses here. Jeremy drove a total of 12,000 miles, of which 9,000 were for private journeys. Very clearly, therefore, 9/12 of this is going to be disallowed. So back to your motor expenses, there on the question page. What we can do is go there, as I said, 9,000 out of 12,000 was private, so plus 9/12. I think we can drop the noughts on that, plus 9/12. On we go to the professional fees. What have we got here? Professional fees are as follows. Accountancy. Well, fine. Accountancy, £700. Nothing. We've got to have accountancy work done for any trading, any business there. So that would seem perfectly fine. The only thing we might say, being that we're accountants, is it not nearly big enough. We'd like that to be a much bigger figure indeed. But no, accountancy, 700, at this point anyway, seems okay. Legal fees in connection with the purchase of the clothing shop. Now then, with legal fees, this comes under that same basic rule of, is it a revenue expense, is it capital expense? Anything that's capital is not allowable against the trading income. This is the purchase of the shop. It's to do with the purchase of an asset. Purchase of an asset is capital expenditure. So those legal fees, therefore, in connection with the purchase of the shop are not allowed and will need to be added back. They are added back. So legal fees, look at what it is in relation to. Is it a revenue item like debt collection? Like, oh, that's a bit of a giveaway, isn't it? The next one, debt collection. Tick, that one is perfectly fine. Or was it to do with the drawing up of employee contracts? All of that is trading, that's fine. But if it's to do with the purchase or indeed the sale of an asset, that is capital and therefore is disallowed. Again, you might think that's a little bit harsh because it seems like a perfectly reasonable business expense, but it is dealt with within the tax system. It's just not here under income tax. If you've incurred such capital expenses when you purchase the property, when eventually you sell that property, then those expenses, those capital expenses you've incurred, the legal expenses on the purchase of the property, there will be allowable deductions as a cost there against the sales proceeds. They will serve to reduce that chargeable gain. So yes, you will get tax relief, but in a capital gains calculation when eventually the property is sold. Okay, debt collection of percent is fine, but then having thought all was fine with the accountancy, we discover included in the figure for accountancy is £250 in respect of a capital gains tax computation. Now, that will be a capital gains tax computation for the individual. Do you think that working out a capital gains tax cost for the individual Jeremy has got anything to do with the business and would therefore be allowed as a trading expense? I'm hopeful that you're saying not a chance. No. So that is a private expense item, and therefore the 250, add back, put a plus sign next to the 250. Right, we're rocking and rolling here. Note 4, repairs and renewals. Here we go. We've got 5660 in total. What does it say? The figure of 5660 includes £2,200 for decorating the clothing shop during July 16. Now, the information that we had here about this business, we look back to the start here, is that on the 1st of June 16, Jerry commenced in self-employment running the retail shop. What you've got here, therefore, is decorating the shop during July 16, perfectly reasonable repair maintenance expense. So that one is fine. £1,050 for decorating, oh, there's the word, the private flat. It's private. Private use, not business use. That, therefore, is not allowed. Put a plus sign next to your £1,050. It is clearly not allowable. We're also told that the building was in a usable state when it was purchased. Now, there is a reason for that. We were told that we just bought the property. Again, we started in there on the 1st of June. We just bought the property, and then after we have just bought it, we've incurred that decorating cost. Now, there is an issue that says if you buy an asset and you then carry out what looks like repairs expenditure, repairs maintenance expenditure, then as long as that asset was usable, might not have been much good, but it was usable, then the expense you then incur is allowable. But if you were ever told here that the building was not in a usable state prior to it being decorated, then the expense item is disallowed. So the basic rule to apply: you buy an asset, you carry out a repair. If they tell you that the asset when purchased was usable, then it is a revenue expense when you repair. If they tell you, however, that when the asset was purchased, it was not usable for the purpose for which it was acquired, then the repair expenditure is treated as capital and is disallowed here in the adjustment of profits. So again, one to watch for. But here, fine. The only problem we've got is the private use item. Note 5, sundry expenses. Here, well, all sorts of goodies can be found within this. Includes £640 for gifts to customers of food hampers. Food. Doesn't matter what they cost, whether it's £40 each or whatever. Remember, so far as gifts to customers are concerned, they must, yes, cost less than £50. Yes, they did. They must represent a conspicuous advertisement for the business. Well, no reference to that. But the point is, it must not be food, drink, tobacco products, or exchangeable vouchers. This clearly is food. As soon as you see that, it's disallowed. You don't care how much it cost. So 640, add back, put a plus sign next to that one. Next one, £320 for gifts to customers of pens carrying an advertisement for the shop, costing £1.60 each. No problem. All of that is allowable. We can see cost less than £50, conspicuous advertisement for the business, and it's not food, drink, tobacco products or exchangeable vouchers. I'm sure it's not an edible pen, and on that basis, therefore, yes, that expenditure will be allowable. We now get donations and subscriptions. £100 for a donation to a national charity. Donations to national charity, not allowed. Put a plus sign next to the £100. Disallowed. £40 for a donation to a local charity's fete. The fete programme carried a free advertisement for the clothing shop. What do you reckon to that? It's small, it's local, it represents an advert. Yeah, this is fine. That, therefore, will be an allowable expense. Watch out in terms of how examiners could, dare I say, trick you here. Not that they do try to do that, of course. But here, this self-same item, £40, donation to local charity, Fate's programme carried the free advertisement, but what you're then told is that Jeremy made the payment under the gift aid system. If it was paid under gift aid, it's separately dealt with as we saw in Chapter 2. It's not a trading expense, and on that basis, it would be added back. So watch out for that one. Typical little ploy, tell you all the stuff that would make it allowable, but then tell you that it was paid under the gift aid system, not therefore allowable, add it back. Wages and salaries of that figure includes an annual salary of £15,500 paid to Jeremy's wife. She does work in the clothing shop, so fine, yes, you can employ whoever you like as a sales assistant, but the other sales assistants doing the same job paid an annual salary of £11,000. So what do we do here? Very clearly, and they've got to spell it out for you, so it's not difficult in practice to try and find out what these differentials might be, but not difficult here. We're paying above a normal commercial rate to a family member. Commercial rate 11,000, actually paying 15.5. What is the difference? Plus add back 4,500 plus 4,500 there, the excess above the normal commercial rate. Add it back. Note 7, goods for own use. Jeremy took clothes out of the shop for his personal use without paying or accounting for them. So we bought them, they went through purchases, part of the stock there of the business, and then we just helped ourselves and not recorded anything through the accounts. Remember what the rule therefore is, we add back at selling price. Add back at selling price. What does it say here? The cost of the clothes was £460, selling price £650, add back the £650. What would we have done if instead it had said that we had accounted for the cost of those goods taken? Then the cost of the goods was £460, the resale value £650. If we've already accounted for the cost, £460, it's the profit element that now needs to be added back. We take £650 minus £460, which I think might equal £190. And that would be the add back. We'd add that back. So read the question carefully. Normal rule, add back at selling price. But if we've already adjusted for the cost, there's no further, the further add back is simply for the profit element there, as you see with that example. Finally, no work for us to do here, because on plant and machinery, what replaces the disallowed depreciation charge? Capital allowances. And we're told there that for the period, they're 13,060. As the note then says, in the exam, they're not likely to give that to you. That's a figure, in a written question anyway, that you're going to have to work out for yourself. But that awaits us, as we say there, in Chapter 5. What I want you to do now, however, is to make sure you've noted down all those adjustments, compute therefore what you think the tax adjusted trading profit of that business, of Jeremy's business, is, and check that out with a model answer. Once done, again, there are practice questions that you can have a go at here, and then ensure that you're ready to join us in Chapter 5, where we deal with, as just mentioned there, the capital allowances available on qualifying plant and machinery. As ever, look forward to seeing you there.